If you're interested in becoming a smarter investor and learning how to build long-term wealth, today's video is for you. We're diving into the book, Invest Like the Best by Chris Belchamber. This insightful guide takes you through the key principles and strategies used by some of the world's most successful investors. Whether you're new to investing or looking to refine your approach, this book offers valuable lessons that can help you make better financial decisions. In this video, I'll break down each chapter in detail and show you how you can apply these lessons to your daily life. And remember, if you want to dive deeper into the content, there's a link to the full book in the description below. Let's get started. This is Wealthilocity, where you create, protect, and grow your wealth fast. Chapter 1 sets the stage by exploring the evolution of investment thinking. Chris Belchamber explains how investment strategies have changed over time, from the traditional buy-and-hold approach to more dynamic, data-driven methods. This chapter emphasizes the importance of understanding the broader context of financial markets and how different strategies have emerged in response to changing economic conditions. To apply the lessons from this chapter, start by expanding your knowledge of different investment strategies. Don't just rely on a single approach. Instead, educate yourself on a variety of methods, including value investing, growth investing, momentum trading, and more. This will give you a broader toolkit to draw from as you navigate the markets. Additionally, consider how you might need to adapt your investment strategy based on the current economic environment. For example, during periods of high market volatility, you might explore strategies that focus on capital preservation or seek opportunities in alternative assets like real estate or commodities. The key takeaway from this chapter is to remain flexible and open to evolving your approach as market conditions change. In Chapter 2, Belchamber dives into the relationship between risk and reward, a fundamental concept in investing. He explains that while higher returns are often associated with higher risks, it's crucial to understand and manage those risks effectively. This chapter teaches you how to assess your own risk tolerance and how to build a portfolio that balances risk and reward according to your personal financial goals. To implement these ideas, start by assessing your risk tolerance. Are you comfortable with the possibility of losing money in exchange for the potential for higher returns? Or do you prefer a more conservative approach that prioritizes capital preservation? Understanding your risk tolerance will help you make informed decisions about which investments are right for you. Next, diversify your portfolio to manage risk. By spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities, you can reduce the impact of a downturn in any single asset. Diversification is one of the most effective ways to balance risk and reward, ensuring that your portfolio remains resilient in various market conditions. Chapter 3 highlights one of the most powerful forces in investing: compounding. Belchamber explains how compounding, earning returns on your returns, can significantly boost your wealth over time. This chapter underscores the importance of starting to invest early and staying invested for the long term to maximize the benefits of compounding. To harness the power of compounding, the most important step is to start investing as soon as possible, even if it's with a small amount. The earlier you start, the more time your investments have to grow. For example, investing $100 a month in a diversified portfolio with an average annual return of 7% can grow to over $120,000 in 30 years, thanks to the power of compounding. Additionally, reinvest your dividends and interest payments rather than cashing them out. This allows your investment to grow more rapidly over time. If you haven't already, consider setting up automatic contributions to your investment accounts to ensure that you're consistently adding to your portfolio, which helps to maximize the compounding effect. In Chapter 4, Belchamber delves into the field of behavioral finance, exploring how psychological factors can influence investment decisions. He discusses common cognitive biases, such as overconfidence, loss aversion, and herd mentality, that can lead investors to make poor decisions. This chapter emphasizes the importance of self-awareness and emotional discipline in achieving long-term investment success. To apply the insights from this chapter, start by becoming more aware of your own cognitive biases. For instance, if you find yourself holding on to a losing investment because you don't want to admit defeat, a behavior known as loss aversion, try to reframe your decision-making process. Focus on the future potential of the investment rather than on past losses. Developing a disciplined investment strategy can also help mitigate the impact of emotions on your decisions. This might include setting strict criteria for buying or selling investments, sticking to a long-term plan, and avoiding the temptation to react to short-term market fluctuations. By recognizing and managing your psychological tendencies, you can make more rational and effective investment decisions. Chapter 5 focuses on building a robust investment framework, a systematic approach to making investment decisions. Belchamber outlines the key components of a successful investment framework, including setting clear objectives, conducting thorough research, and maintaining discipline in your execution. To build your own investment framework, start by clearly defining your financial goals. Are you investing for retirement, saving for a major purchase, or building wealth for future generations? Your goals will determine your investment strategy, time horizon, and risk tolerance. Next, commit to conducting thorough research before making any investment decisions. This includes analyzing the fundamentals of individual stocks or other assets, understanding market trends, and staying informed about economic indicators. The more informed you are, the better equipped you'll be to make decisions that align with your goals. Finally, maintain discipline in your investment process. This means sticking to your plan even when market conditions are volatile or when you're tempted to make impulsive decisions. By following a consistent and well-thought-out framework, you'll increase your chances of long-term investment success. Chapter 6 emphasizes the importance of continuous learning in the world of investing. Belchamber argues that successful investors never stop learning. They constantly seek to improve their knowledge, stay updated on market trends, and adapt their strategies as needed. To incorporate continuous learning into your investment journey, make it a habit to read books, articles, and research reports on investing and financial markets. Attend webinars, workshops, and conferences to learn from industry experts and network with other investors. Consider subscribing to financial newsletters or joining investment forums where you can exchange ideas and stay informed about the latest developments in the market. By committing to lifelong learning, you'll be better equipped to navigate the complexities of investing and make informed decisions that align with your goals. Also, don't forget to regularly evaluate and refine your investment strategy based on what you learn. The more you know, the more effectively you can adapt your approach to changing market conditions and new opportunities. In Chapter 7, Belchamber introduces the concept of dynamic asset allocation, a flexible approach to managing your portfolio that adjusts to changing market conditions. Unlike static asset allocation, where you set a fixed percentage of your portfolio to different asset classes, dynamic asset allocation involves regularly reassessing and rebalancing your portfolio based on market trends and economic indicators. To implement a dynamic asset allocation strategy, start by setting a baseline allocation that reflects your risk tolerance and financial goals. For example, you might allocate 60% of your portfolio to stocks, 30% to bonds, and 10% to alternative assets. Then, regularly review your portfolio and the broader market environment. If you notice significant changes in economic indicators, such as interest rates, inflation, or geopolitical events, consider adjusting your asset allocation to better position your portfolio for those conditions. For example, in a rising interest rate environment, you might reduce your exposure to bonds and increase your allocation to equities or real assets like real estate. The key to dynamic asset allocation is staying flexible and responsive to market conditions while maintaining a long-term perspective. This approach can help you manage risk and take advantage of new opportunities as they arise. Chapter 8 explores the role of alternative investments, such as real estate, commodities, private equity, and hedge funds, in a diversified portfolio. Belchamber explains how these non-traditional assets can provide additional diversification and potential for higher returns, especially in times of market volatility. To incorporate alternative investments into your portfolio, start by researching different types of alternative assets and their potential benefits and risks. For example, real estate can provide steady income and long-term appreciation, while commodities like gold can act as a hedge against inflation. Consider allocating a small portion of your portfolio to alternative investments, depending on your risk tolerance and investment goals. These assets can add diversification to your portfolio and help reduce overall risk. However, Keep in mind that alternative investments can be more complex and less liquid than traditional assets like stocks and bonds, so it's important to understand what you're investing in. If you're new to alternative investments, you might start with publicly traded REITs, real estate investment trusts, or commodity ETFs, exchange-traded funds, which offer exposure to these asset classes with lower entry barriers and greater liquidity. Chapter 9 of Invest Like the Best is all about understanding and managing risk in your investment portfolio. Chris Belchamber emphasizes that successful investing isn't just about picking the right stocks or assets, it's also about managing risk effectively. He introduces key concepts like drawdown, volatility, and diversification, which are essential for protecting your investments from significant losses. To implement the principles of risk management in your daily investing routine, start by assessing the level of risk in your current portfolio. Review each asset to understand its risk profile, including how it has performed historically during market downturns. Next, consider diversifying your investments across different asset classes, such as stocks, bonds, and real estate, to spread risk. Belchamber also suggests using tools like stop-loss orders to limit potential losses on individual investments. A stop-loss order automatically sells an asset when it reaches a certain price, preventing further losses if the market turns against you. Another important aspect of risk management is regularly rebalancing your portfolio. As some investments grow faster than others, your portfolio can become skewed toward riskier assets. Rebalancing ensures that you maintain your desired level of risk by adjusting your asset allocation back to its original target. By incorporating these risk management strategies, you'll not only protect your investments from significant losses, but also increase the likelihood of achieving your long-term financial goals. In Chapter 10, Belchamber delves into the critical role of emotional discipline in investing. He explains that emotions like fear and greed can cloud judgment, leading to impulsive decisions that often result in poor investment outcomes. This chapter provides practical advice on how to maintain emotional discipline and make decisions based on logic and data rather than emotions. To cultivate emotional discipline in your investing, start by developing a clear investment plan with specific goals and strategies. This plan should include your risk tolerance, time horizon, and asset allocation strategy. Having a plan in place helps you stay focused during market volatility, reducing the likelihood of making impulsive decisions. Belchamber also recommends practicing mindfulness and stress management techniques, such as meditation or deep breathing exercises. These practices can help you stay calm and composed during market fluctuations, allowing you to make more rational decisions. Another effective strategy is to set up rules for when to buy and sell assets, based on predefined criteria rather than emotions. For example, you might decide to only buy a stock if it meets certain valuation metrics, or sell if it falls below a specific threshold. By sticking to these rules, you can avoid the common pitfalls of emotional investing. Finally, consider keeping a trading journal where you document your investment decisions and the reasoning behind them. Reviewing your journal regularly can help you identify emotional triggers and patterns in your decision-making, allowing you to make adjustments and improve your investing discipline over time. Chapter 11 emphasizes the importance of having a well-defined investment process. Chris Belchamber argues that a consistent process is key to achieving long-term success in investing. Rather than chasing the latest trends or reacting to market noise, a strong process helps you stay disciplined and focused on your strategy. To develop your own investment process, start by outlining the key steps you'll take when analyzing potential investments. This might include 1. Research. Identify investment opportunities based on your goals, risk tolerance, and preferred asset classes. Use fundamental and technical analysis to evaluate potential investments. 2. Selection. Develop criteria for selecting investments, such as specific financial ratios, industry trends, or economic indicators. Stick to these criteria to ensure consistency in your decision-making. 3. Execution. Establish rules for entering and exiting positions, including setting price targets, stop-loss levels, and position sizing. This ensures that your trades are driven by logic rather than emotion. 4. Review. Regularly review your portfolio and investment decisions to assess performance. Analyze what worked, what didn't, and why. Use these insights to refine your process and improve future decision-making. By adhering to a structured investment process, you'll minimize the impact of emotions and market noise, leading to more consistent and successful outcomes over time. Chapter 12 highlights the importance of continuous learning and adaptation in the ever-evolving world of investing. Belchamber explains that markets are dynamic, and staying informed about new trends, technologies, and economic developments is crucial for long-term success. To keep learning and adapting as an investor, commit to ongoing education. This could involve reading books, following financial news, taking online courses, or attending seminars and workshops. The more you learn, the better equipped you'll be to spot opportunities and navigate challenges. Belchamber also encourages investors to remain open to new ideas and strategies. While it's important to have a consistent process, it's equally important to be flexible and willing to adapt when circumstances change. For example, if new technology emerges that could disrupt an industry, consider how it might impact your current investments and whether you need to adjust your strategy. Networking with other investors and professionals in the industry can also be valuable. By sharing insights and experiences, you can learn from others' successes and mistakes, broadening your own perspective and knowledge. Finally, regularly review and update your investment plan to reflect your evolving goals, risk tolerance, and market conditions. Continuous learning and adaptation are key to staying ahead in the world of investing. In Chapter 13, Belchamber discusses how to build a portfolio that can withstand various market conditions, often referred to as a portfolio for all seasons. The idea is to create a balanced portfolio that performs well in both bullish and bearish markets, protecting your investments during economic downturns. To build a robust portfolio, start by diversifying across different asset classes, such as stocks, bonds, real estate, and commodities. Each of these asset classes tends to perform differently under various economic conditions, so diversification helps reduce overall risk. Consider adopting a core and satellite approach, where the core of your portfolio consists of broad-based, low-cost index funds or ETFs that provide exposure to the overall market. Around this core, you can add satellite investments in specific sectors, industries, or strategies that you believe will outperform the market based on your research. Belchamber also recommends including assets that typically perform well during times of economic uncertainty, such as gold or other safe haven assets. These can act as a hedge against market volatility and provide stability during downturns. Regularly review and rebalance your portfolio to ensure it remains aligned with your investment goals and risk tolerance. By building a well-diversified portfolio that's designed to perform in various market conditions, you'll be better equipped to achieve consistent long-term returns. The final chapter of the book, Chapter 14, brings together all the lessons from the previous chapters to provide a comprehensive blueprint for successful investing. Belchamber emphasizes the importance of integrating all aspects of risk management, emotional discipline, process, continuous learning, and portfolio construction into a cohesive investment strategy. To implement this final blueprint, start by reviewing your entire investment approach. Ensure that each element, from risk management to portfolio diversification, is aligned with your overall goals and strategy. Create a written investment plan that outlines your strategy, risk tolerance, goals, and the specific steps you'll take to achieve them. This document should serve as your roadmap, guiding your decisions and helping you stay disciplined over the long term. Next, commit to regular portfolio reviews, where you assess performance, rebalance your assets, and make adjustments based on changing market conditions or life circumstances. These reviews will help you stay on track and ensure that your investments continue to align with your objectives. Finally, remember that investing is a marathon, not a sprint. Success in investing requires patience, discipline, and a long-term perspective. By following the blueprint laid out in this book, you'll be well-positioned to navigate the ups and downs of the market and achieve your financial goals. And don't forget, if you want to dive deeper into all these concepts, you can find a link to the full book in the description below. And there you have it, a detailed summary of Invest Like the Best by Chris Belchamber. This book is packed with valuable insights that can transform your approach to investing, helping you build a strong, resilient portfolio that stands the test of time. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit the notification bell so you don't miss out on more content like this. And as mentioned earlier, the link to the full book is in the description below if you want to explore it further. Thanks for watching, and I'll see you in the next video with more money in your pocket.